What's up you guys, welcome back to the channel. In today's video we are taking a look at what a credit score is, what determines your credit score, and finally how to set yourself up to have a perfect credit score as soon as possible. So if at any point you find any of this information helpful, do me a favor and drop a like down on the video, I'd really appreciate it, and share it with anyone who might also find this helpful. So now with that out of the way, let's hop into it. First off, let's start with what a credit score is. A credit score is an individual grade that determines how much of a risk you would be to a lender and statistically how likely you are to actually pay them back. Your credit score can range from anything between 300 to 850 at the very highest. Why is 300 the lowest? I have no clue. Your credit score is vital to many of the things you may want to do, such as renting an apartment, getting a car loan, mortgage, or even getting a loan on a business. And the sooner you can start building your credit, the better. Why, you may ask? That all has to do with what your credit score is comprised of. Your credit score is impacted by 5 things, so let's break them down one by one. The most important metric based on its total weight would be your payment history. Your payment history accounts for 35% of your overall score. The way the system calculates this is that it takes your on-time payments and divides it by your total payments. So say for instance you have 2 credit cards for 12 months, and out of all those months you only miss 1 payment on one of those cards. Across those 2 cards you have a total of 24 payments, and of those 24 payments you made 23 of them on time. That will leave you with an on-time payment percentage of 95.8%. Now you may think that's a really good ratio, but no. According to this graph by Credit Karma, that is actually really bad. But now let's say you have 2 credit cards, but for 50 months this time, and you still only have that 1 late payment. Then that would leave you with 100 total payments, with 99 of those being on time. That would then bump you up into the green with 99% of your payments being on time. Now this one is really simple and straightforward to get right. Just simply never miss any payment on any of your loans or your credit card. Now you should always be paying off your credit cards in full by the end of every month. But if for whatever reason you can't, then at least make the minimum payment on the credit card, which typically is around $20 or $25 on most cards. Like I said, this one is the easiest of them all to do, but if you do happen to miss one of your payments, then that is going to tank your score and stay on your account for 7 long years. Now the second largest contributor to your overall credit score is your total amounts owed, or what is most commonly referred to is your credit utilization. This one is also pretty straightforward. Basically, the more money you use, the worse it's going to impact your score. But this is not calculated by a single dollar amount. Instead, they do it as a percentage of the total amount of credit you have available to you. So let's say you just got your first credit card with a $200 limit. You then go to the mall and buy a $200 pair of shoes. You would have just made one of the biggest mistakes you could have, and that would have been by maxing out your credit card and using 100% of your total credit limit. This would bring down your score by several points because you would seem like a riskier borrower for needing to use all the money that they lent to you. But for another example, let's say you still spent those $200, but instead your credit limit is now $1,000. Your credit card company isn't going to care as much because all they see is that you only use 20% of your overall limit. So to get a higher score, you really want to be using less than 30% of your overall limits, but ideally less than 10% if at all possible. So to put it bluntly, you are rewarded for not needing to use all the money they give you access to, and penalized if you do need to use more or all of the money they lend out to you. Because the lower that percentage is, statistically, the less of a risk you pose to any given lender. So the best way of maintaining a low credit utilization is by having opened several credit cards with high limits. And the way you can get a higher credit limit is by opening up a credit card and then after at least 6 months of on-time payments and low utilization, just call the number on the back of the card and ask them to raise your limit. Now this should go without saying, but I'm gonna say it anyways just to be crystal clear. But you should never be spending any money on a credit card if you don't have the money in cash or in your checking account to immediately pay it off. And you should never be using a credit card as a replacement for an emergency fund. Because the way I see it, at that point, you would basically just be digging a hole without a way out and lighting a stick of dynamite expecting it to blast a way out of there. Now, ignoring the fact that you probably wouldn't survive, dang, that got dark quick. At that point, you would just be making the hole even larger and even harder to get out of. Third, the reason you should get a credit card as soon as you turn 18 is because the average length of your credit history is the third largest contributor to your overall credit score, making up 15% of it. Let me explain. Let's say that you listen to the rest of the advice in this video and you get one card when you turn 18. But instead of applying for another card a couple months or a year later, you decide that one card is good enough for you, and you keep that one card for 10 years. 10 years go by and you finally decide to get a second credit card. Your average credit history with only one card is 10 years. But then after you get your second card, your average would then drop to 5 years. You'd be 28 years old with an average credit history of 5 years long. But now let's say, instead of you only getting one card, you decide to get two. And you keep those two cards for 5 years. And let's just say that you do everything exactly the same as the person who just had one card. And let's also say that you kept your utilization ratio and your payment history exactly the same as the person who only had one card. You would be in the exact same position at 23 years old with two cards as the person 5 years older than you who had just gotten their second credit card. As long as you both kept everything exactly the same except for when you got your second credit card, you would both have the same total number of payments and the same average history. And so long as you kept everything else exactly the same except for when you got those two credit cards, you would both have very similar if not identical scores. Except that the 23-year-old did it in half the time by solely getting a second credit card when he was 18. And even though new lines of credit will drop your average length of credit history, the overall effect it has on your credit score will get lower and lower as you get more and more. So like I said, if you only had one credit card for 10 years and then decide to get a second one, your average length of credit history would drop to only 5 years, so it would be cut in half. But if you have 5 credit cards for an average of 10 years, and then you decide to get a sixth, your average length would drop to only 8.3 years, which is a huge difference. Now, the fourth aspect of your credit score is your mix of credit or the variety of credit that you have, and this makes up 10% of your overall score. Lenders really want to see that you can handle not only multiple lines of credit, like multiple credit cards, but also a variety of different credit, like a mortgage, credit card, and car loan. And finally, the remaining 10% of your score is made up of your total amount of new credit or new inquiries that you have had in the past 12 months. See, whenever you apply for new lines of credit, like a credit card, car loan, or a lease, they all get reported to the credit bureaus so that they can keep track of how often you're asking for new credit. And generally, the more often you go out and apply for new lines of credit, the more likely you will be seen as a riskier borrower because it looks like you really need the money and may not have the money to pay it back. But if you are looking to buy a house or a car and you have your credit pulled multiple times within a couple days or weeks, then most likely the credit bureaus will group them all into one because they recognize that you are probably just shopping around rates and don't want to penalize you for being a savvy consumer. So to summarize all of this, the way you can get set up to have a good credit score is by starting off with 1 to 2 credit cards as soon as you turn 18, or right now if you are currently over the age of 18. Now, my only 2 recommendations with this is that to make sure that your first 2 to 3 credit cards have no annual fees. Because ideally, you should plan to keep these cards open indefinitely and to be the backbone of your credit history. My second recommendation is to make sure that whatever credit cards you get, they have zero liability. What this means is that if someone steals your card or your card information, then whatever money that they spend on it, you will not be responsible for paying it back, so long as you report the transactions in a timely manner. This one tip has already saved me $200 in the past 2 weeks when someone bought something at Best Buy using my credit card information, and all I had to do was call up my bank and dispute the charge. It literally took me not even 10 minutes. After you get your first credit card, make sure to stay below 10 to 30% of your total credit limit, and make sure to pay them off in full every month without fail so that you avoid interest. Then once you have done that for at least 6 to 12 months, call up your credit card company and ask them to increase your limits so you can show an even lower credit utilization. And in terms of monitoring your credit, you have a couple different options. First off, you can request your full credit report for free once every year by going to annualcreditreport.com. And you can use other services like Credit Karma or Credit Sesame to monitor it more frequently. But you do have to understand that any service that you use other than your annual credit report will most likely not be spot on, but it will give you a very good indication of where you're at. And although your credit score can go all the way up to an 850, the benefits of having a high score typically tap out between 740 to 760. So if you were to apply for a loan and you have a credit score of 760, you would get the exact same benefits and low interest rate as someone who had an 850. And finally, if anyone wants to know how I made a couple $100s in just the past year by only having one credit card, let me know in the comments below and I'll make sure to make a video all about that. But with that said, that wraps it up for this week's video. If you want to keep up with any of my new videos, make sure to subscribe for a brand new video every Monday. And while you're down there, make sure to drop a like on the video. I'd really appreciate it. And with that said, thank you all for watching, and I will see you all next week with another video.